Greetings and happy holidays to everybody. I hope this has been a relaxing, wonderful time of year with your friends and family, with good food and drink and laughs. We are going to put a bow on 2022. I don't think I speak for myself when I say most people are ready to turn the page to 2023. And we have a nice look back at 2022 in store for you today. I've got some slides to share. We preview some themes that we're looking at for next year. Today is the 28th, so almost to year end, not quite. So if some of the numbers are a little bit different, that's why most of you will get this in a few days. So with that, let's get into the business end of this presentation. It's going to be a little longer than usual just because it's year end, but I will try to not ramble on and stay on the rails here. So I'm going to share my screen. December 2022 video commentary. Let's get into it. Okay, so I'm going to move my little face here, and this is essentially the S&P 500 throughout 2022. So the left side of this graph would be January all the way up to the end of the year. The line is the S&P's journey. You can see it's been choppy, it's been down, it's been ugly, and I think these are interesting because it feels like we had weeks in 2022 that felt like years. There was just a lot going on, and we were blitzed with headlines from inflation to Russia invading Ukraine, gasoline prices hitting record highs. The Fed set out in their most aggressive rate hiking campaign since 1994, and it was just one thing after another where there was no respite. There was not really any place to hide unless you were in cash or shoveled money into oil stocks, which no one really wanted to own oil stocks for the last 15 years. So our focus really was everyone is going to experience pain in this environment. Every investment strategy under the sun is going to feel stress. It became mitigating damage. So let's go through this and unpack 2022. So this is the equity market. This was the same events, but this was the 10-year yield. Okay. So inflation, rising rates, it turns out are bad for both stocks and bonds. And I've said this in a few of my client meetings, but just to provide some context for this year, since 1928, there's been exactly 1 year that the 10-year treasury and the S&P 500 were down more than 10%. That year, you guessed it, is 2022. So this really is an outlier, a black swan, call it whatever you want. This was a once in 94 year event where stocks and bonds both were down over 10%. That does not happen. So people talk about diversification breaking down, and is this the end of the bond market, and do bonds work anymore? I would pause to come to such a radical conclusion. Things like this happen, doesn't happen often, but if I was to sum up 2022, these two charts do a really good job. And to put a bow on that, I would say this was the year that diversification broke down. So it didn't matter if you were an aggressive investor or conservative investor. Many asset classes that we track were down 10 to 15%. So I showed something similar in a previous month commentary. This is the S&P 500 going back post-World War II. 20% declines from all-time highs. So finding the all-time high in each one of these years or the previous year and showing the drawdown from that, and the drawdown needs to be, as you can see here, 20% plus. So the red is 2022. So you can see it's been not straight down like 2020, which was a pandemic, but more this choppy meandering to the downside. If the current low holds, the low would have been in October. And then for context, you can see how 1987 stacks up to this year, 2007 and 2000. So I highlighted, and you can throw 1980 in there. So I highlighted more recent events and the late 80s, the early 80s, which of course a lot of policymakers and investors compare to this current environment due to the higher inflation and higher rates. So not as aggressively down on the pace, but not as drawn out as 2000 or 2007 or as steep, knock on wood. But this is where we're currently at in the context of post-World War 20% drawdowns. Okay, so that's what it looks like on the downside. I've had people ask me what the recovery could look like. So this is basically taking those same years and looking at the first year after the low. So after we get the 20% decline, we hit a low. What does the first year after that look like? And you can see, again, red is 2022, and we've got this meandering line on the upside. And this recovery, if you can call it that, is weaker than the typical recovery. And the strongest recoveries were 1982, 2009, and 2020. So these right here, and you can see that we're below those. But in general, this is not a hard and fast rule. In general, up markets, the following up market, following a drawdown, those tend to mirror each other. So like 2020, for example, was a huge bounce back. It also was a huge sell-off on the downside. So again, I can't predict what this is going to look like, but it wouldn't surprise me if our bounce back was this meandering, clumsy drift to the upside, much like the downside was a meandering drift to the downside, although probably it didn't feel like that during some periods. We had some violent downswings over the course of 2022. The key takeaway here is that bad markets tend to be a precursor to better markets. And conversely, the bliss of 2021 was a precursor to an ugly market in 2022. So markets move in cycles. I know we have a tendency to extrapolate what's going on currently into the future. That's not really the way markets or investing works. So maybe next time, if you found yourself making suboptimal decisions or getting carried away in crypto or Tesla stock or any of the high-flying tech companies, know that markets do move in cycles and nothing lasts forever. All right, so we're getting a lot of questions about a recession and when we're going to get a recession. So this is basically a index that tracks leading economic indicators. So it takes a pool of these indicators and tries to project future economic activity. And when this line is falling, in general, that signals economic weakness. When this line is rising, that's in general signaling economic strength. Now, year over year, this index is down 2.71%. Okay, and I'm going to read something so I don't misquote it. So declined 2.71% year over year. Since 1960, when this index declines by more than 2%, the economy was on the verge of a recession, already in a recession, or on the way out of a recession. So I'm hearing a lot of talking heads saying, oh, we predict a recession in late 2023. This is not jiving with that. We are either, based on history, based on this index's track record going back 62 years, we're either on the verge, we're already in, or we're coming out of a recession. No one can know, no one can even agree on what a recession is these days. But this is a pretty good indicator. It's got a pretty good track record, and this is something that we are watching. So sticking to the recession theme, we've covered what that means for stock and bond markets in the past, and we're going to cover that again in the next slide. But what does a U.S. recession actually mean as far as months go? And there's really two stories here. One is pre-1945, pre-World War II. The U.S. economy was still in its early stages. It was still maturing. Recessions tended to be deeper and longer, and you can see that here. The numbers back that up. So this is recession length in months, pre-1945. Post-1945, you can see recessions are less painful, and they're also shorter in length. So as economies grow, as they get more mature, the swings in the business cycle tend to be more tame. And that the length of recession and pain of the recession shows up here. Okay, so now we're going to get into a question I've been getting a lot. So if there is a recession, Nick, let's say there's a recession on the horizon, what asset classes perform well? How can I position my portfolio to mitigate damage in a recession? So what this is asset class performance, I should say, going back from 1960 to 2021 for equities, lower quality bonds, bank loans, which we won't really talk about here, investment grade corporate bonds, and government bonds. All right, so these are the four stages of a business cycle. The recovery, so the bouncing, coming out of a recession, the expansion phase, the slowdown, and the contraction. So we can look at the contraction and say, this is economic activity shrinking, the economy shrinking. By definition, that would be a recession. And historically, again, going back to 1960, investment grade bonds and government bonds are the best performing asset classes. So again, I know people are disappointed or disgusted or shocked by this year's bond market performance, but historically, high quality bonds, investment grade bonds, US Treasury bonds have performed best during a recession. I'm not going to say that's going to happen during the next recession, but historically, government bonds, high quality corporate bonds have been a pretty good place to be. If you're a pure client, you have a decent sized weighting to both of these asset classes, more so on the government side, but you do have some corporate bond exposure. And for larger portfolios, we favor buying individual bonds because we know exactly what we own. It's basically a contract. We know when we're going to get paid interest. We know when that bond matures. And in this environment, when rates are going up, we've leaned into the shorter maturity bond because one, they're less sensitive to rates going up. And two, they mature sooner, meaning we can take advantage of those higher rates. Bond matures, we get cash, we reinvest at higher rates. It's a win-win for everybody. So one of the silver linings this year I've talked about in my musings, in my blog musings, has been fixed income finally has income, right? Bonds are finally paying a reasonable yield, reasonable interest. So what we've done here, and this is a hat tip to Invesco, we've looked at various asset classes, and I believe this goes back 80 years. So various global asset classes showing their average yield over the last 60 or 80 years, and that's marked by this X, right? So you see the X, X, X. And if the blue box is above that X, that means currently those yields or dividend yields are higher than the historical average. If this blue box is below the X, that means it's below, the income is below the historical average. And this is probably the least covered silver lining to 2022. If you're a net saver, if you're a retiree, being able to clip 3, 4, 5% off your investment portfolio has been a missing ingredient in the last 10 years. You've almost exclusively had to rely on your assets going up in value. And let's say you're targeting a 7% return and that's baked into your financial plan. Well, if you can get halfway there through dividend income or corporate bond income or government bond income, is a lower hurdle. That 7% becomes a lower hurdle to reach. So this is a positive for net savers and net investors. And you can see there's a couple asset classes: corporate high yield, corporate bonds, cash, government bonds are close to their historical average that are really attractive right now, paying on the corporate bond side close to 5%, close to 6% yields. On the government bond side, about 4%, which is in line with historical averages. So this is something similar. So in 2021, everything was trading very richly. Stocks were overvalued when we look in hindsight. And basically what this is a smoothed out price to earnings ratio. So how cheap or expensive a market is. So again, here's some global asset classes and countries. And this X is the average PE ratio over the last 10 years. Okay, if this blue box is below, that means that asset class is trading cheaper than its historical average. If the blue box is above, that means that asset class is trading more richly or fully valued compared to its historical average. And you can see some things are absurdly cheap, like Japanese and Chinese stocks. Some asset classes, some countries are still expensive relative to their historical averages, like India and the US stock markets. So again, I think valuation is a really good predictor of longer term returns, not so much on the shorter end. It says nothing about timing. So it's not like I can look at Chinese stocks and say, okay, these are historically cheap. I'm going to shovel money into Chinese stocks. Well, they could stay cheap for a decade and they could underperform for a decade. And that's really what's happened in emerging markets and even foreign markets. They've stayed cheap. They've stayed below their historical value, while US has stayed expensive relative to their historical value. And what that means in terms of performance, US markets continue to outperform over the last 12 years foreign markets underperformed over the last 12 years, even though markets were saying foreign stocks are cheap, US stocks are expensive. They can stay that way for longer than most people expect. Let's talk interest rates, which this is really interesting. I've shared a similar chart in previous versions. So the next Fed meeting is February 2023. The current Fed funds rate is 4.25 to 4.5%. Okay. The market is pricing in for the February 2023 meeting a modest hike of 0.25% or a quarter of 1%. There's a 65% chance the Fed only hikes by a quarter of 1%. Looking back at 2022, the Fed has hiked 0.75% and most recently a half of 1%. So the Fed is still restrictive. They're still raising rates to pump the brakes on inflation, but they're becoming less aggressive. And this is the natural progression that we've been waiting for the Fed to slowly pump the brakes and reassess the impact of their aggressive rate hiking cycle. And they've been able to slow the pace or potentially further slow the pace of rate hikes because inflation has started to normalize. Okay, so there's a lot going on here. I'll explain the signal amongst the noise. So November's monthly inflation reading came in lower than expected. It was basically flat month over month. It was up 0.1% month over month, which was essentially flat because that annualized inflation rate, when you take 0.1 and multiply it by 12, is a modest 1.2% annualized. Okay, the Fed's imaginary inflation target is 2%. If we continue to get these modest inflation prints, essentially flat or modestly up month over month, so this is the area I'm looking at. This would be flat month over month. This would be what we saw in November. This would be what we could see going forward if inflation happens to tick up, right? So these modest 0%, 0.1%, 0.2% increases. If we continue to see these, playing this movie forward, inflation would return to the Fed's 2% target, actually go below in June of 23. Okay, and I've circled that here. If inflation runs a little hotter, so over 2% or even over 3%, it would take inflation a little longer to normalize. In this case, it would be end of year 23, and in the hotter than expected case, we'd still be above their 2% target well into 2023. In this case, you might expect the Fed funds rate here in this far right column to be above 5%. But you can actually see if we do get this normalized inflation returning to the Fed's 2% target, it wouldn't surprise us to see the Fed cut a little bit. So inflation matters. A lot of investors are watching this. The Fed is watching this. There's 1,000 different ways to calculate inflation, but it's good to see some progress. If current inflation levels hold and this continues, it looks like inflation would have peaked in June of 2022. Okay, so let's talk a little bit about the opportunity set of investments. And I kind of hinted on this in our CAPE ratio and dividend yield charts that we showed earlier. But to no one's surprise, the last 10 years, call it 12 years, starting in 2010, the S&P 500 has vastly outperformed global markets. And basically what this is, it's comparing the S&P 500 to an all-world stock index. Okay, and when this line is going up, that means US stocks are outperforming global stocks. When this line is going down, that means global stocks are outperforming US stocks. The last 10 years, the clear winner has been US stocks. That's started to change the last couple months. US stocks have vastly underperformed emerging markets and international developed. In my opinion, that's a good thing. It's good to see balance. It's good to see potentially the baton passing. Play this movie backwards a little bit, and back in from 2000 to 2010, US stocks essentially were flat for the decade, while emerging market stocks and foreign stocks were up. So it was basically the opposite. So a lot of investors are saying this could potentially be an inflection point where global markets start to outperform US stocks. I'm not saying that's going to happen, but again, markets move in cycles. Investing is not simply looking at what's performed best and shoveling money into that asset class, although that has worked going back the last decade. but it would not surprise us if international stocks, emerging market stocks, which have been beaten down for over a decade, start to outperform because they are cheaper than US stocks. And when you look at dividend yield also for a lot of these global companies, they're much higher than US stocks. But again, what's cheap can stay cheap. What's expensive can stay expensive. So this says nothing about timing, but I just think it's an interesting theme to watch going forward. Another theme that's been popular with investors, that's been really a great trade the last 10 years, it's been disastrous this year, has been this growth trade. A lot of investors shoveling money into tech stocks, big tech, high flyers, cryptocurrencies, meme stocks, COVID economy themes. All of those stocks, all of those themes have been the epicenter of the pain this year. And what goes up must come down. If it goes up violently, it often comes down in an aggressive manner as well. And growth, again, has outperformed value stocks for over 17 years. It's been one of the biggest periods. It might be the biggest period of growth outperforming value. And when I say value, think old economy stocks like banks, energy companies, industrials, defensive names. So these value names are starting to perk up, are starting to act better relative to growth stocks, which again have been the center of pain this year. So many investors are starting to look at some of these beaten down stocks, beaten down themes, but then you also have this faction of investors that think that it's going to be a return to glory for a lot of the big tech names. And you have to think about the background when big tech and all these frothy growth names were flying high. It was a low inflation, stable inflation, zero interest rate environment where investors were incentivized to take risk. If you think we're going back to that environment, that might be a good trade, investing in big tech. If you do not think we're going back to that environment, you might look elsewhere. Again, investing is not as easy as shoveling money into the 5 best performing stocks. So a lot of astute investors are starting to look at value again and placing bets for not what has happened yesterday, but what could happen tomorrow. And I think emerging markets and international are in that same vein. You could also throw in bonds. I think bonds are probably, again, the most hated asset class this year because the returns have been ugly. But again, when you look at recessions, when you look at starting yields being a predictor of future performance, there's a lot to like about bonds as well. So I hope this has been interesting for you. We're trying to just throw out ideas, give you a sense of some of the themes that we're watching. I know this has been a difficult year for people. If you have any questions about your portfolio, if you're a pure client, feel free to reach out to us. Continue to follow our content. If you're a prospective client and working with another advisor and want us to take a look at your portfolio, we are happy to do that. We're not salespeople. We often give people candid feedback. If there's a fit for you at Pure, that's great. If there's not a fit, we can help you find a different advisor or a better fit for your needs. So take advantage of our free portfolio review. We've gotten good feedback on the process, and I wish you all a wonderful new year. Hopefully there's better things to come in 2023. Take care.